Hello everybody, welcome to Suffolk Business Life. My name is Craig Sennett and with me today is Kevin Ward. Hey Kevin, thanks for coming to the show.
Afternoon, Craig.
One of the parts of the show, as everybody knows, is all to do with running businesses locally, what having a business is like in the community. Kevin I know quite well. Before we get on to what he does currently, can you tell us a little bit about your career, what you did previously?
Okay, I've had a slightly varied career for someone that's come from a banking world, which is what I've done most recently. Started off in the hotel industry, which I went into from school, so all about hospitality, looking after people, customer service.
I didn't know that, and I've known you for years.
There you go. Yeah. And went from there into the motor trade, which my father had always worked in. So I did that for a few years in various different roles, from salesman through to running a dealership.
Okay.
And then I did kind of fell into financial world. The financial advisor, IFA, and then ultimately into banking.
Oh, see, I didn't know you were an IFA at one point either.
Yeah, there you go.
Right. And obviously you moved into banking eventually. I mean, do you find there are any differences from, for example, your lengthy career in automotive industry to banking? Are they a huge amount of similarities, or?
There's a lot more similarities than people would probably think, because at the end of the day, it's like most businesses, you have a customer, and you want to keep that customer happy and provide the relevant service or product to that customer. So there's synergies in that respect. Obviously, there's obviously lots of differences as well, because you're talking money and
products versus services, essentially. Yeah.
Absolutely. Yeah. But ultimately, it all comes down to relationship.
So how or what was it that drew you into banking? You know, was it a natural progression from the IFA time, or?
To a large extent. I mean, the motor trade I kind of fell into originally, and it was good, and I enjoyed it. And I sold lots of cars, which was great when I was selling, ran successful teams, which was good fun. But it's also long hours, weekend work. It was never the plan to go into that for the long term. My father really didn't want me to, having always worked in it. Yeah. And I liked the idea of getting involved on the financial side of things. At school, I always wanted to be an accountant. They taught me out, but they said I'd get bored. Yeah. So I got a job offer to be a financial advisor from Lloyds TSB. On the basis I went in for a financial review, and it turned out to be a job interview.
Okay.
And I quite enjoyed it and got on well, but decided I wanted to be an independent financial advisor, which I did for a couple of years. And then, unfortunately, a redundancy meant I looked at other options, and one was going back in the motor trade through someone that headhunted me. Did that for a couple of years, got some great experience of running teams and a dealership, but then decided I liked the financial side of things more, and the hours, and targeted becoming a corporate banker.
I suppose obviously for a difference, I mean, when I've spoke with IFAs in the past, they tend to come and see me on my time rather than necessarily going, whereas obviously with the banking sector, you tend to go and see a banking individual on their time, sort of thing. You know, it's sort of more working hours, sort of thing. But you know, sort of 9 to 5, attending Monday to Friday, sort of thing. With obviously you've got your own business now, sort of Kevin Ward Limited. Essentially, what is it you do now then? I mean, how previously you worked, with your banking. What was it you did previously in banking versus what you do now? Similarities, changes?
There's some similarities. I was a relationship director when I left Barclays, and that meant I looked after a portfolio of customers, about 60 to 80, and I had a sector specialism with the motor trade, funnily enough, as well as law firms and one or two other bits and pieces. So you looked after your portfolio of customers. It was very relationship focused. They were all at least 5 million turnover upwards, so they're fairly sizable corporates, and as a rule, the biggest was about 150 million turnover.
Okay, yeah.
And it was driving that relationship to make sure the customer was getting what they needed from the bank in respect to funding, the service levels, everything else, trying to come up with creative solutions as required, and then utilising the team resource that was there to give the customer what they needed, which that became more and more challenging, I have to say, as time has gone over the last few years, as you can appreciate.
Yeah, of course, yeah.
What I'm now doing is kind of sitting on the other side of the fence. I suppose quite a few people have deemed me a gamekeeper turned poacher. And I'm working with clients to help them with their bank relationship. What it isn't doing, it's not trying to get them, 0.5% off the rate they're getting. I mean, I'll do that if I can. But that isn't the focus. The focus is around improving the bank relationship, so it's a true partnership that's enabling that business to move forward with its plans to achieve its goals in the long term, which you're not going to do if you haven't got a good, strong bank relationship.
So would that be, I suppose, oversimplifying it, essentially taking what a business does on a day-to-day operating procedure and turning that into data in bank speak.
There's a strong element of that, and there's an element of putting together, if there is a funding requirement, a pack to support the request to the bank, to make it actually really hard for the bank to say no. And it's bearing in mind, I know and understand how the credit teams work, who are the true decision makers at the bank. So I target the managers at the banks and work with the good guys that really make the effort to understand their customers. But there's a real focus on making sure that you're giving the credit team what they need to make a positive decision.
I think one probably a very valid point there. I mean, you obviously see a lot, and I've seen a lot of business owners know their business really well, but they don't know what bits about their business a bank's going to want to know to make that lending justification. It's kind of you sit there and talk about what you do for a business, but a bank wants to know certain key elements of data, financial turnover, profit loss, director security, equity, all sorts of things like that, and being able to relate that in a way that's going to look favourably to a bank when they're looking to make a lending judgment.
Absolutely, and unfortunately lots of accountants and other professionals, they've got a great grasp on the whole of how things need to be, but they don't really understand quite what it is that the bank is looking for as a lender. I
suppose obviously you've seen that side being, and keep its own poacher sort of thing. With sort of businesses, obviously, I remember hearing on the car radio on the way up here that the economy has officially been in sort of recession again for 9 months now. Are you seeing a different type of problems with business owners, or good news with business owners, or are you seeing much the same that we saw 9 months ago?
It's a bit of a mix. I think what has happened is, in the best possible way, you've cleared out a lot of the rubbish.
The ones that were going to fail anyway,
That's right. And there's a strong element, obviously, in the family businesses, second or third generation, where they weren't really up to it, and they've been getting away with it for the last few years. Now it's just got to that point, the recession, double dip, if you like, has been going on for so long that actually that they couldn't sustain it any longer, and they've gone one way or another. So that's something that has changed, and the last 9 months have brought that to a head for quite a few businesses.
From an employment point of view, you get a similar thing, which is slightly more my background. The first round of redundancies were people that companies did where people didn't want on, and as time's worn on, departments have had to close or people have had to be made redundant, and it pushed people onto the employment market that would not normally have been on it. They might have been somewhere 10-15 years, just because the companies failed.
Which, because there's a great opportunity for those companies that have good quality management. And that's what I am seeing. It doesn't matter what sector it's in. It could be a sector that's traditionally seen as a challenging one, healthcare, for instance, and motor trade as well. But if you've got a good quality management team in place, and they'll be doing the right things, they'll be making the right plans, strategies, and they'll be working hard to implement them, adjust them when they need to, they're doing okay. I'm not saying they're doing well, but not in trouble. And they're able to therefore take opportunities such as, that guy, he's brilliant, he's on the market now, we want him, he'd be ideal for the future. So it's about surviving at the moment, I think. It's also where you have got a good management team, you'll see that they're trying to get some foundations in place that will enable them to grow in a sensible way when things start to improve, which is actually when you see most businesses fall over in a recession.
Similar thing with my own business. I mean, I've most of our work has become overseas now, because we do a lot of work in Dubai and sort of places like that, because the economy is that much stronger than it is compared to the London one at the moment. But it swings and roundabouts and stuff. I mean, are there any sectors you're seeing that are doing particularly well locally?
Probably not, to be honest. But equally, there aren't any sectors that I'm seeing doing really bad. And locally, we are quite a steady part of the country. You don't see dramatic highs or lows. The closest you get is Cambridge with the IT and everything else.
IT, bridge technologies, highway and stuff like that. I mean, I've always, one of the things I've often said to people about sort of local business essentially is Suffolk is sheltered from the very highest of up times, but it's sheltered from the very worst of crashes. It kind of has that smaller variance. Places Cambridge maybe like this, sort of Suffolk a bit more. It's one of the things I do notice about business locally is there's an awful lot of loyalty. When you get a customer, they will, they're very loyal to you, and that's something. It can take longer for decisions to be made within businesses, and sometimes they may want the window cleaner to have a say in whether they're going to spend 300 quid on something, I mean, hypothetically. But once you do land a customer, Suffolk has a tremendous loyalty within the business community.
Yeah, I think that's fair. Yeah, certainly.
And again, I think, this kind of takes me on sort of jumping around my sort of schedule slightly. It takes me on to something I remember as a kid, my father going to Midland Bank. It shows how long ago it was, Midland Bank. Basically, he would go into the bank probably about once a week, for never really sure why, because I was a little kid sitting in the back of the car sort of thing. But the impression I had then was my dad had a good relationship with his bank manager. He knew who his bank manager was. And I think personally and commercially that's possibly changed a little with our time. Would you say that's fair? Technology's changed it a bit?
I think it has. It depends what size of business you've got, firstly. Because if you're in a smaller business bracket, which for most of the banks now is sub 5 million turnover, the resource within the bank to look after the customers is limited.
Yeah.
So a start-up business manager will probably have 800 customers.
Right. Okay.
So that's a challenge to speak to
Difficult to get around it. Yeah, of course.
And you're not going to have a relationship, and it is more computer says yes or no. And as you move up, when you get sort of 3 to 5 million, they've probably got 100, 150 customers in a portfolio. So you're starting to get more to a relationship focus, but a lot of it is driven by product sales and things of that nature. So it's more a situation where banking is really a commodity at that level.
Yeah.
Then when you start moving into what we'd usually class as a corporate arena, you do get a relationship manager or director, and in theory, it is very much focused on the relationship with the customer, and that relationship should drive what products they need, and therefore that's what's supplied. And if the relationship is right, the customer hopefully is happy with what they're getting. The bank is going to make money from the services that they're supplying to that customer. Of late, I would probably suggest that with the bigger banks, certainly, it's been moving further away from that relationship. Some because there's more compliance, more challenges internally around the administration required, so therefore the managers haven't as much time to devote to their customers. But also the strategies of the banks have changed, and things aren't the same as they used to be in that respect.
I suppose in a way that's a good opportunity for you as with your business, is you can start to you only need to know 5 or 6 different banking managers as your inroads for funding and relationship building and stuff like that, and that as a service is, I suppose, in a way one of the things you offer to clients. They come to you because they want the interface that they're probably not getting at the moment.
Yeah, and the problem is the managers don't always have the time, and unfortunately in a lot of cases the inclination to work to understand the customer. And ultimately what went wrong with the economy, is certainly as far as the banking side of things is concerned, is there's 2 fundamentals to lending money. One is security, so that if it's a mortgage for your house is the security. The second is making sure that it's serviceable, i.e. you can afford to repay the debt, which again, putting in simple terms of a mortgage, is 3 times your salary. It's probably affordable. 10 times it's not. Well, that is exactly how it works at all levels of lending. Now, the way you look at it, security is easy, obviously. You've either got it or you haven't. Serviceability, though, it's driven by financial information, which is fine. Anyone can produce the financials. You can get the accountant to do some wonderful forecasts, everything. But ultimately, it comes back to that management team again and their ability to deliver those financials. And what has unfortunately dropped off from a lot of the banks over the last few years, because things were quite easy, it was easy to lend money because everyone was making money. The management analysis side to lending money almost disappeared. A lot of the time, say, good management team.
I couldn't believe how easy it was for me to get the start-up funding for my business. I got it within 25 minutes of walking in the door. It literally they sort of said, can you put together a business plan? And I said, well, I've actually got one, and they were quite stunned that I actually had one. And they said, okay, and I said, do you get many people come in and ask for lending without one? And the banking manager I was talking to went, yeah, we do. We get a lot of people. And I was like, all right. So, but I was quite surprised later that day the funds were put into my account. In 3 years we paid it off. We paid it off 2 years earlier. It took over 5 years, cleared it off after 3. But I was surprised how easy it was to get that money, because I must have been 28, 29, something like that.
And it was really easy at one point. Really, it was pawnbroking. Especially the security had the money. And it's getting back to looking at that serviceability that much more, but there's still a gap where with the exception of the odd niche operation bank such as Handelsbanken, who've got lots of branches opened, that most of the bankers do not look at the management team, and ultimately it's the management team that will deliver that financial performance to drive the serviceability.
It's them that's in the sling to the deliverable end, basically.
And I think when it comes to borrowing money, the bit that I'm focused on is demonstrating categorically, in detail, how the management team are capable of implementing the business plan to deliver on the forecasted financials.
I remember reading or hearing an article of Alan Sugar was at some business meeting, and someone had asked him about banks, saying, well, banks aren't lending any money, and I completely agree with what he said. He said, well, if they're not going to get it back, they're not going to lend it.
Absolutely.
You wouldn't give a mate of yours money who's never got any. He's up to his neck in debt. You might give it to him as a gift, but banks aren't in the gift industry. They're in the getting a return on their investment. A lot of people, £375 billion worth of quantitative easing's gone into the economy. I don't think banks wisely and rightly so have used a fair proportion of that to prop up balance sheets and stuff. Because they need to make sure their business is cash rich and solvent, and that they can be safe enough to borrow money at favourable rates and stuff in the world economy. That all makes perfect sense, but not a lot of it seems to be reaching further down the chain. Do you agree with that? Disagree?
Well, I do agree with that, but I think there's a few reasons as to why that is. I think one is there's inevitably a number of businesses that are asking for money who it is the wrong thing to lend them any further money. Because actually, that isn't going to solve their problems. It's a short-term fix, and chances are the lender will lose it. So you're right with exactly what you said and what Alan Sugar said. You wouldn't lend someone some money if you knew categorically you're not going to get it back. There's then businesses where there isn't really an effort made to clearly understand the business and that management team, and that's
the sort of thing where you would come in.
Potentially, that's right. And that's a more worrying one for me. And sometimes the business doesn't know how to ask for the money, right, or the information given doesn't portray the right picture, and it makes it too easy for a bank to say this isn't a viable business long term. Because how do you define viable, which is the word the government use? So it's easy for the bank to say no. So there is what I think is a genuine issue with the banks not lending where actually the business deserves it, but arguably there's also an issue with the business and how they're asking for it. I've also seen a lot of scenarios where the businesses don't want to ask for the money, and they're either worried that it will give the wrong impression that they're asking for money, or it's a case that they're assuming they won't get it because we all keep hearing that banks aren't lending. So a lot of people make the assumption there's no point in asking a bank because they're not going to lend anything. Okay,
here's a thought. I mean, I don't know if you know the answer to this. I mean, I certainly don't. If you're a business owner here, sitting here now, watching this, thinking, well, I've got a good business. It's got a bit of equity. I want to do a bit of expansion, or possibly buy another business. Mergers and acquisitions seem to be quite a reasonable thing at this time. When there's a depressed economy, those with money look to take advantage and buy up some of the struggling competitors. Again, it makes good business sense to do so. But if you're sitting there looking at your balance sheet, thinking, it's okay, a bit of cash injection would enable us to go and get a share, buy another company, innovate something in, or branch out into a new area that we've been looking at doing. Do you think essentially that when you go for finance as an individual, we hear this thing about too many credit checks against your business will show favourably in your personal credit reference? Is it the same for companies?
No, because to be honest, I mean, it depends to some extent on the size of the company again. But in most cases, and certainly in the sort of slightly larger arena, 3 million upwards probably, possibly 1 million upwards to be fair, the credit assessment is undertaken by your manager, your relationship director initially. So they're your first point of sanction, if you like. If they don't want to do it, you're not going to get anywhere. So that's why you need to have the right person with the right relationship. Then it's going to go up to a credit team. It doesn't go on a credit scoring system. It's not that they'll look at Dun & Bradstreet and see how your business looks. They'll assess it to make sure there's no really bad credit there, CCJs, that sort of thing. But actually, that's as far as that goes. In general, what they're going to look at is they're going to look at your historic performance. And they might take a lot of, it depends on which way the wind is blowing as to how much credence they give that.
Yeah.
They'll look at where you are, and obviously they'll look at where you're going, and that, in theory, they'll look at the management team's ability to do it, and it's an analysis done by that manager, presented to the credit team, who will then either ratify that and say, yes, we agree, or not, as the case may be.
So there's no potential risk to business owners sort of thinking, there's no harm in making that inquiry.
Not at all.
Obviously, a lot of it's down to how you pitch it, and
absolutely,
whether it falls on deaf ears or whether or not they think it's viable and they're likely to get return.
And actually, if you've got a good relationship with the bank manager, you should be able to chat it through and discuss it before it gets to a point of actually putting up a full credit request to the credit team anyway. They will have a good idea of what the appetite is, whether they admit it or not. Pretty much all of the banks have a credit policy for each sector of business, and that manager will know what that credit policy is, and they'll know, for instance, there's some of the banks out there who just will not lend to property related investments or developments of any kind. It's just a categorical no.
I suppose that they've got to spread their risks in terms of the portfolio where they're lending. If you lend purely to, I don't know, the IT sector, and then there's .com boom happens, your bank's in jeopardy, let alone all your client base, sort of thing.
Yeah, and that's what caught some of the banks out. They had a much greater exposure to one sector than they arguably should have done.
With sort of going back to the small business sort of side of things, essentially, if you've got you're looking at starting a business, we keep hearing in the media it's a really good time to do it. Lots of people made redundancy money, invest in a business, go and do what they did previously, or life-changing experience and that. What should a new business owner, someone starting up, expect from their bank?
Well, the first thing is you need to find a manager at the bank that you get on really well with.
Yeah.
And arguably it shouldn't matter which of the banks you go to. They should all be good at this.
Yeah.
So you find someone you get on with, hopefully they'll then introduce you into a nice local accountant who you can get on with, and you'd hope that you would get a nice support pack, which most of the banks produce, and a bit of guidance around your PAY if it's required, and everything else of that nature. At the moment, the challenge with that is that a lot of the start-up business managers do have these portfolios of 800 odd customers in. So they do have very limited scope to spend that much time with people. And unfortunately, there's a strong element that a lot of these people will get very sceptical because they see so many things. And there's often people who come in, they've got a fantastic idea, they've seen a niche in the marketplace which they're going to go for, without realising that actually lots of other people have gone for that, and there's no one doing it for a good reason. You can't make money from it.
Of course,
so you have to overcome that, and that's where it's important to find someone you get on with, and then you'll get something back.
Yeah, okay. When we talked off air earlier, I mean, something that came out of it, we were talking about why it is perceived that certain banks don't lend money and that there's not enough loans being written and they're falling short on government lending quotas and stuff like that. Something that you sort of said that struck a bit of a chord with me. I mean, at the end of the day, it's wrong of anyone out there to expect a bank not to make money. They're a business. They've got to make money. So if you've got a pot of, I don't know, for ease of, hypothetically speaking, 50 grand to lend to, the care industry, the care home industry sort of thing, and you're sitting there, you've got a couple of applications in for people, and you'll think, well, I've got a set amount of money, I can't meet everyone's criteria. You're obviously going to lend that money to who's going to give you the best return. That's right. It's literally quite often that simple. I know people I've been talking to have been saying, banks wanting ridiculous interest rates and stuff like that, and that's why people haven't at times taken up some of the funding. But a bank's got to look at balancing its risk and get a return on it. Yeah,
that's right. And you will find all of the banks now are looking at what's called their risk-weighted assets. They're looking at what money they've lent out, what risk is there, and it costs them more, and they have to put aside cash for the riskier the lend that they've done. So if it's £100,000 lend and it's a real chance of default, they've got to set aside £100,000
to cover the loss.
So effectively, they're putting out £200,000 instead of 100.
Yeah.
The low risk though, they might only have to put 5,000, well actually 12,000 or thereabouts aside. So it genuinely does cost them more money the riskier the scenario that's there, and they do need to make money. The bit that I do have a bit more of a challenge with around this is that you're right, it's important for the bank to make money, and if there's two different scenarios out there with the same level of risk but they can make a bit more money out of this one than that one, then I'm seeing increasingly they'll go for the one where they can make more money. Where I have a bit of an issue is that the other customer might have been with them for 100 years and that one for 6 months.
Yeah.
And that's where the loyalty factor in some cases is gone out of the window, unfortunately, which is why it's even more important to find a banker that you're getting on really well with, to have that relationship to avoid that sort of scenario.
I think that's very important. I mean, when you, as a business owner, when you've got an accountant, you need an accountant that understands what it is your business does.
Yeah.
If you've got, if you need to involve any legal representation, you need someone that really understands what the issue is. I mean, you don't go, for argument's sake, if you've got a matrimonial legal problem, you don't go and get a property conveyancing lawyer to represent you.
Yeah.
You go and get someone that deals with that, and it's the expertise that people pay for. I mean, I suppose really just chucking a curveball in there, in terms of your own experience, what would you say is some key advice to give to people, aside from the obvious of get a bank manager that that understands and stuff like that? I mean, are there any sort of real gold nuggets of information that you've seen from sitting on the other side of the fence?
I think there's a few key things. Firstly, have a business plan, but make it one you're going to use. Because the amount of times that I saw a business plan and someone would pick it up at the top of the drawer of the desk, it's pristine, it's lovely, it looks wonderful, really thick, but it's quite clearly never been opened since the day it was written. So have a clear vision, have a plan to make it, to enable you to reach that vision of all of the things you need to do, have goals along the way you need to achieve, and make sure that you've got the ability and experience, both yourself and within your business, to implement it. If you haven't got those 4 things, you're not going to get anywhere to start with. The second thing is having good advisors. And I'm a great believer in getting people in that are better than you at everything possible. Yeah. And that includes accounts and the legal side, you're right. The accountants now, what I would say is, if you are looking to borrow money, you do need to probably look at a larger firm than you might have done before.
Okay.
The banks, when they're assessing a credit risk, if you're with someone who's a one-man band, who might be very capable, but actually that's not really what they want. They want to see that you're with a firm which has probably got more than 2 or 3 offices across a region, area, whatever.
And there's plenty around here like that, Scrutton's, PKF, people like that.
In Swords, that's
right.
Yeah,
in Swords as well, yeah.
And they've got people who are tax experts, both personally, commercially. They've got commercial finance people. They've got people that will understand the general sort of accounting that you need to do for your end of year financial, everything, and importantly forecasting. If you're just with Joe Bloggs up the road, then there's going to be an element of like, well, we don't know this guy from Adam. Can we rely on his figures?
Well, there's always good regional firms. I mean, Andrew Dyer, I've had on here from Beaton, sort of thing, as another example.
Absolutely.
And I think, again, it's all about confidence, isn't it? The whole economy, really, it's a bit fictitious. The whole economy is built on confidence.
Yeah.
Lending rates and all sorts of stuff like that, consumer confidence. That the whole thing seems to be, almost kind of like a Hollywood. It's all about the appearance rather than, it needs foundation.
Yeah.
But if confidence is high, bankers tend to lend a bit more. And I think with people like yourselves, a good accountant, if needs be, a good, good legal representation, stuff like that. That's all stuff that's going to give confidence to a bank, and
it's removing reasons to say no.
Yeah, it is, but essentially it's a basic sales ploy. You need to understand what your end goal is and be able to present yourself as trustworthy, creditworthy, and all, low risk.
Be aware of what objections there might be,
and cover up with them beforehand. And I think that's something a lot of people. I don't know why. Still, a lot of people in business aren't business people. And that's why people like that need to rely on services such as yourselves, the accountants, legal representation, and stuff like that, because I don't do my own accounts. I ain't got the first clue what I'm doing with my accounts. I tried doing a VAT return once and realised I did it for the wrong 3 months. So I said, right, that's it, I'm never doing it again. But I think it's by outsourcing time-consuming but important jobs like that, you can get on with doing the bits of the job that you're good at, and and then ultimately that adds to success of a business sort of thing. I think there's
few people that can do everything themselves.
Yeah, I agree. And I'd sort of like to say thank you very much for coming on board. It's been it's been great to have you here, and it's been good to get your insight from the other side of the fence, and also what you think of the economy as well. So thank you very much for coming in.
Pleasure. Thanks, Colin.
Thank you.